Hi, this is Stephen here from Share Navigator, and this is your option and future trade update. It's October the 17th. So, this is a good one, guys. This is an important one. I'd love you to listen to the entire video and rewatch it again. I think it's going to create some great opportunities. So, for a while, we've been talking about we need some sort of a shakeout in the market to cause the market to pull back a bit to give us an opportunity to get in. And I think we might be getting it now. There's a possibility of a US regional bank crisis. So yesterday, Zion Bank and Western Alliance were down 13% and 12% respectively, basically for loan loss provisions to a company that invests into distressed assets. So both of them were caught on that. One was caught for 50 million. Small numbers by stock market standards, but these are small regional banks. And the question is there more out there? Also, during the week, we know the car dealership Tricolor went bankrupt, Forced Brands as well. JP Morgan even were on the hook for that for 170 million for these loan loss provisions. And Jamie Dimon himself, who's the CEO of JP Morgan, came out and said, when you see one cockroach, there tends to be others, so you're forewarned. The regional bank index was down 6%. So, folks, it's not so long ago we seen this picture before with Silicon Valley Bank. I don't know if you remember 2 years ago, not quite the same thing, but that bank went under, and then there was a big shakeout in the market because of the fear of regional banks going down. The Fed kind of brought a lot of positive speak to the table very quickly and propped up the market there. And I think something like that's going to play out again, right? But you need to understand what the risks are. Think about it. If you're the manager of a regional bank all over the US and this is starting to break, I'm sure you're getting all type of calls and investigations from the regulators and from your own management teams about lending. And the knock-on impact is you're probably less likely to lend against this backdrop. So that can slow an economy down. So you have to bear that in mind as well. So that's the first thing. The second thing is there a risk of contagion? Don't forget, banks lend to each other overnight. It's called overnight financing rates to balance the books. And, how many company or banks have lent to each other that might be at risk? And this becomes part of the problem here. So that's why you're seeing banks all over the world this morning now down. It's because this risk of contagion. Another thing you've got to be aware of as well when we're talking about the stock market is Bitcoin is down. It's down to like a 3 month low. Gold is up at its highest. Bond yields are down. So the flight to safety is on. So the stock market futures are down 1.2%. I'll get to the charts in a second and I'll go through the potential trades on that. And don't forget, it's Friday. Friday, do you really want to be holding stocks over the weekend, given that we don't know whether this is going to escalate or de escalate? So, in the absence of news from the Fed today or some calming impact, this sell off could intensify throughout the day. We're just going to have to wait and see. We don't know. We can't predict what somebody may or may not say. But the silver lining is the Fed. And we have seen over the last 16 years since the financial crash, if there's any time there's stress in the market, the Fed step in. So with that in mind, I think this is setting us up nicely for some of our short put option trades on the S&P 500. So I'm going to look at the charts now, and then I'm going to talk about the potential trades that we could place even today, or maybe we might leave it till Monday. So here's a quick look at KRX. That's the regional bank index ETF. You can see down 6% yesterday. So this is the impact of the news that we've just spoken about. This is Zion Bank here. You can see big drop off, and in pre-market it's down again, and you can see Western Alliance here, the knock-on impact here. So this is really what's causing a bit of jitters in the market at the moment. And then I suppose we got to look at Bitcoin as well. And I mentioned this yesterday in our member support meeting. Why is Bitcoin important in all of this? Well, if you think about the amount of people that are probably leveraged up into Bitcoin, and if Bitcoin falls heavily, there's a knock-on impact into the stock market on that, because if there's margin calls on people and investors with Bitcoin holdings, because it is so volatile, that move there, by the way, is a 20% move. The market has only moved 2%, where the Bitcoin, is down about 15% at the moment, and the next support area is a further 5% lower. So you think about it, if those investors are getting margin calls, they could be forced selling stocks in order to maintain their cryptocurrency position. So there is an important play here as well to be cognizant of. Also, if you look at the safe havens here, if you look at bond yields, look what happened. Bond yields yesterday straight down to 3.95%, and they're getting They're going lower again today. So this indicates that people are flying the stock market and going into safety. The demand for safe assets is there. And then again, if we just switch into gold very, very quickly, you can see here gold is at all-time highs. So just as a matter of, just as a comment, if you're in gold at the moment and you think this is going to be a temporary thing with the regional banks, you might want to actually use this just on a short-term basis, this sell-off in the market maybe to lighten up your gold positions, because if there is a recovery in the market, you're going to probably see gold prices come back then a little bit after that. So just keep that in the back of your mind if you're invested into gold. It's something to be wary of. And finally, just on the charts, I want to show you the picture of the VIX. So this is the volatility index. And this leads me on to our option trades. This is great for us, guys. Volatility shooting up means we're getting paid big time for selling insurance policies on the S&P 500. And that's what we're going to talk about and what we're going to do. We're going to set up our trade there. So you can see the futures are down about 1% at the moment. What's key here, folks, is this previous low here today. So if you look at SPY, just for example, the low was 652.84. If that gets taken out today, that could indicate that we're going down further on Monday. So we're just going to have to see how this plays out. We may get the Federal Reserve speak before the market or something like that, saying everything is fine, and that might give the market a boost. So this could all change very quickly. But all I'm saying is right now, as of yesterday, the market was up nearly 1% at one stage yesterday, and then there was a big reversal on this as investors started to panic. It's gone through to Asia, it's in through to Europe, and the futures in the US at the moment are down 1%. It's very early in the US at this minute in time. So this could change with some positive calming influence. What we're going to talk about now is what trade we could potentially line up. But before I do that, we're going to talk about our existing oil trade, and then we'll talk about the S&P 500. So our two existing positions, the short put on the 620 SPY that expires tomorrow, nothing to do there. That's going to expire worthless. But look at this turnaround here in crude oil. So this is the short put option that we sold at the 55 strike. Crude oil is now trading at about 56.80. When we first placed this trade, crude oil was at $60. And what we said was we'd much prefer to give ourselves some wiggle room for the trade to go wrong rather than go long on crude oil outright. And we were right to do that because crude oil has come down since, and we're still above this strike price here. Now, the trade at this minute in time is underwater because the value of that put option has gone up. And remember, we sold the put option. So against that backdrop, that means that we're in a short-term unrealized loss position of $420 a contract. We're going to hold on to this trade because we would see potentially crude oil rebounding. Obviously, there's talk with Russia and the Ukraine and everything like that as well, which is probably adding to the pressure on crude oil. But we think over the short term, crude oil is likely to rebound, and therefore we're going to keep that trade on. But again, it's just to highlight the benefit of the short put strategy, giving yourself wiggle room for things to go wrong. So now let's just focus in solely on the S&P 500. This is a great opportunity to use this volatility to our advantage. I'm going to focus on some trades that we could go ahead and place now, or we could consider placing. So we're going to look at the option chains here, and I'm going to bring up the futures contract. Now, I've already outlined before, when you're looking at the option chains, there's different ways you can do it. You can do it through SPY, which most of you will probably do it that way, or you can use the futures. This is the main futures contract, or you can use the micro futures contract. So when it comes down to it, I'll explain each one when I'm putting on a trade. I just want to really highlight now, because we're in pre-market and the futures trade 24/5, I can show you what the real life pricing is like. Rather than using SPY, because SPY will be off yesterday's closing. So these will take in the current volatility in here. So you can see at the moment, you're actually generating more than 1% for selling the 6,200 puts on SPY. So what does that mean? It means that we're allowing SPY fall to 6,200 before we'd have to end up going and buying the index itself. So this stock trade here would have an 89% probability of profit. And the reason that probability is so high, the trade is we're selling an insurance policy on the S&P 500. It's currently at around 6,600. We're saying, do you know what, if it fell to 6,200, we'd buy it off you. So it would have to fall another 7 or 8%. Now it can do that, But that's the, I suppose, at that point in time, you would have to ask yourself, do you really want to go long in the S&P 500? And my view is we do. I think the market by the end of the year will revisit its highs, assuming this regional bank crisis doesn't escalate, which I suspect it won't. My view is that the market recovers and takes out the previous high. So this could be a great opportunity if it did fall to 6,200 to go and get it. So this is the trade I'm looking at. What you're talking about is getting paid 1% today for agreeing to buy the index much lower. If the index does fall down there, you get to buy the index. If it doesn't, you keep your 1%. Either way, for a 28-day trade, you could generate a 1% return on investment here with an 89% chance of actually making that return. And that's a trade we like. So we might start limping into that today. We will see. I want to just see how the market reacts today throughout the day. If it starts to intensify and get worse, we might leave it off till Monday. And I'll keep you notified.